When financial markets crash, headlines scream about trillions of dollars evaporating from stock exchanges, mass layoffs, and household assets hitting decade-long lows. It feels like a mysterious force has sucked the money out of the system. Yet paradoxically, in every crisis, governments continue to inject funds into the economy. So where does the money go? Is it truly gone, or is there more to the story? In reality, money doesn't disappear, it shifts. Much of what we call money lost is not physical cash, but changes in perceived value. Assets like stocks, real estate, or cryptocurrency lose value, not because the cash vanished, but because collective belief in their worth dropped. Take stock markets, for example. When investors lose confidence, prices drop. But that doesn't mean someone physically took the money. Instead, it's a mental recalibration of value. What was worth $100 yesterday may only fetch $60 today, not because $40 was stolen, but because buyers now think it's worth less. This is the paradox of value. Money is a tool of measurement and exchange, not a physical object tied permanently to goods. Value, on the other hand, is belief, and price. It's the consensus point between a buyer and a seller. So when media reports that trillions have evaporated, it's more accurate to say the collective mind has reassessed the worth of assets. It's not a theft, it's a shift in perception. Consider the January 2025 case of NVIDIA. On January 26th, everything looked stable. But overnight, a Chinese startup announced a new technology that threatened NVIDIA's core business. The next morning, NVIDIA shares plummeted 17%, wiping out $589 billion in market value in a single day, the largest one-day drop ever. Yet just days later, the stock rebounded. No money was stolen. It was a pendulum of mass psychology. This highlights a crucial idea. Value lives in people's minds. Stocks, houses, or coins hold no intrinsic value. They are worth what people believe they are worth. When faith in the market falters, people stop spending, investing, or lending. Economists call this the velocity of money. How often a dollar changes hands. In a healthy economy, a dollar circulates 5 to 7 times a year. During recessions, it might drop to 1.5. Imagine a restaurant gets $20 from a customer. The owner pays a chef, who buys groceries, and so on. But in hard times, the customer keeps the $20 in a bank account. The money doesn't vanish, it stops moving. And that immobility stalls the economy. Low-income earners are often hit hardest. With little savings and unstable jobs, they are the first to fall off the economic ladder when storms hit. Essentials like food or rent become harder to afford, while the wealthy often see these downturns as paper losses. When headlines claim billionaires lost billions, it's mostly a drop in asset prices, not actual cash. The wealthy still own their homes, businesses, and investments. Their lifestyles remain intact, but the public sees those losses as ominous signs, fueling fear. Fear changes behavior. People save instead of spend. Investment slows. This triggers a feedback loop of lower demand, falling profits, and more layoffs. So where does the money go during a crash? It moves to safety. Savers flock to high-yield savings accounts, government bonds, and money market funds. These feel safe, but their returns are often lower than inflation. A savings account yielding 0.4% against 3.6% inflation means losing purchasing power. Meanwhile, institutional investors and the well-informed shift cash into distressed assets. When markets panic, quality assets get sold cheaply. Real estate, blue-chip stocks, and even entire companies change hands below true value. Those with liquidity, cash on hand, seize these moments. Big players like Apple, Berkshire Hathaway, and global sovereign funds make strategic buys. They don't just survive recessions, they expand. This is called the gravity zone. Where money ultimately flows, it's not about income, it's about ownership. These entities aren't just wealthy, they shape markets, influence policy, and move capital across borders. Take the Walton family of Walmart. From $27 billion in 1997 to $430 billion by 2024. Their fortune grew through downturns. Why? Because they owned the assets, not just the income. In times of crisis, money flows to gold, farmland, and art, assets that hold long-term value. Gold soared after 2008. Farmland in the U.S. has returned 10 to 12% annually for 20 years. Even art, like the Yves Saint Laurent collection, sold for $500 million during a recession. These are not get-rich-quick strategies. They're preservation plays, places where capital waits patiently. But it doesn't stop there. When the dust settles, those who bought low often become the next generation of financial giants. They bought when everyone else was running. So, what does this mean for you? Don't fear money disappearing. Understand how value works. Learn what drives trust in the system. And most importantly, know where the money is moving next. To stay informed, follow our channel. In just 15 to 20 minutes per summary, you can learn economic insights from world-class thinkers like Mankey, Ray Dalio, Bernanke, and more. No heavy textbooks needed, just clarity. Now, let's return to our main topic. Imagine the economy as a giant, 7-deck ship. Each level represents a different income or asset group. When the ship rocks, it's the lower decks, low-income earners, who fall overboard first. They lack savings. They live paycheck to paycheck. And when confidence collapses, they lose jobs, homes, and access to essentials. Meanwhile, those higher up adjust their portfolios. The rich don't panic. They reposition. In every downturn, the story repeats. Money shifts. Ownership concentrates. And a new cycle begins. The key lesson: money doesn't vanish. It flows from weak hands to strong ones. Thanks for watching. If you found this valuable, explore more videos on our channel. See you in the next one.